Accumulation and distribution, I touched on this earlier. This is a big part of my trading journey. It's something I learned about when I first started. Very interesting. I recommend every trader to read into it. Having that understanding of how markets are moving, how markets are full of these fake outs, these squeezes, these moves which evoke the emotion of us human beings. Lows getting taken out for a third time here, or highs getting taken out on the third move there. That leads to people stopping out. That leads to opportunities. And that's what we see with the Wyckoff market cycle. We have these accumulation phases, again, where buyers are accumulating buy orders, accumulating long positions. Eventually, those ranges get broken, those breakouts, pullback, another breakout higher, pullback, another breakout higher. And then eventually, the opposite happens. You get this distribution phase where, everyone that was accumulating down here, they start easing out. Maybe they're easing out here. And short positions start getting building. But again, the market will test highs to see where the buyers are, to see if the buyers are there, the buyers can hold the price above there. But many times they can't, and it's just it's a fake out, it's a fake move, it's a squeeze. Squeezing the short traders out. Many people might get short in here. Typical, again, retail trading might be like, once the move comes lower, makes a break of structure, comes back, then they think, the structure's broke, so now it's a downtrend, I'm going to get short, put my stop on this high or above the high, and then get stopped out, and then the full move happens again. And sometimes you get multiple of these distributions. This phase can go on for a while. Same with the accumulation. And then after that distribution, you get that markdown move. So Wyckoff, definitely recommend all of you to have a look into it. The concepts work. Sometimes a corrective setup is happening in a Wyckoff move. And there's often that overlay, so it's useful to know that, and that just can give you that extra confidence on a trade, can give you that a bit more confidence to maybe put a bit extra risk on that trade or take a little bit more than usual, so you can really get more out of the market on that particular day. These are the kind of things that we can look at as traders. So we look a bit more in detail into these accumulation phases. These are typical examples. Of course, they don't always look exactly like this, but this is a theory. And we can go into charts and look at examples of this. They've happened many times. They're happening all the time. And again, markets being fractal, this can be happening on a 5-minute chart. This can be happening on a 1-minute chart. It can be happening on a daily chart. Typically Wyckoff is working very well on 4-hour, daily, weekly charts, where you can, because that's where the investors and the longer term players are looking at. Really, they're not interested in what's happening on a 1-minute chart. So we can interpret these kind of bigger trends and these bigger moves and these more significant things on slightly higher time frames of Wyckoff. In this example, great one. We've had these impulses down, then we get into this ranging phase, and within the ranging phase there's all these other types of setup we can take advantage of. Here there might have been a corrective setup, there could have been a corrective setup here. Eventually we get that spring. The lows again continually tested to see, are the sellers there? Are the sellers coming in? Is there sellers down here? And this last one typically happens on very low volume. When you see it happening in the futures market, it might only be a few lots traded down here. The market just goes there, and there are not more sellers, or people have already stopped out, and then eventually you get that move. So the market never gives it to you easily. So many times, how many of you traded before and you've got the direction right, but you've just been stopped out, and then you get stopped out and it goes to your direction? Very frustrating. It's something that happens to all of us as traders. The market is not kind. Remember, it's a zero-sum game. It's zero-sum. So for every loser, there's a winner. Or for every winner, there's a loser. Just think about that. So we need to have an edge, and we need to be smart about where our entries are. Entries are a huge thing in trading. And that's what the corrective strategy is all about, is about getting an accurate entry. An entry, often we get the exact high so many times, or we get the exact low so many times, on whatever time frame. It might not be the low for a while, but within that volatility, we capture those spikes. If we look at the reverse side of it, it's distribution. Again, you get those up thrusts where the market is distribution phases. And often this is a corrective setup, maybe on a higher time frame. This is one impulse candle. Then you have this move, you have these tests above highs, and then the market crashes lower eventually. Again, these are lovely setups, and I do always talk about them in the community. when I see one, I say, look guys, we're looking at a distribution setup, this is quite a nice one, I'm looking to get in here, get out there, depending on where it retraced, etc. But guys, I recommend having a look into this, watch a couple of videos of it, just familiarise yourself with it. So when we do identify them in the market, we will be a bit more confident on the trade. Again, schematics, these are similar, same sort of thing, and this would have been potentially a very nice corrective trade. People have been stopped out here, and this is the kind of trade that we're looking to get in around here and crash the market down, entering around from the top. These are fantastic, and when they line up nicely with our fibs and our corrective trading strategy, these can be very nice trades. And you see the same thing here, markdown, accumulation, spring or failed breakout. That's what we're getting in. We're getting in on that spring, and then we're taking it back above the accumulation range. Same here, uptrend, distribution. We're getting in on that upthrust, and we're selling it down for these failed continuation trades. These are fantastic opportunities. I recommend looking at Wyckoff schematics because there is an overlay with Wyckoff and the way that we are trading. Wyckoff again spans back decades. Richard Wyckoff goes back to, I can't remember which decade, 50s or 70s or something. But it has its roots in psychology, and it has its roots in how institutions and these big players trade, because they push markets often where they want to get it in. They understand trader psychology. Again, markets are always going to where the action is. Where is the action? Where are the key points of interest? Where are traders going to be active? Like, where are people going to be shocked or happy or scared, or where are they going to react in the market? That's where the price wants to go. And that's the example here. You have the upthrust. Again, the market's crashed down. It's made a new low. People want to get short after this point. No, the market's going to drive it higher, drive it above that upthrust level. That's where people are going to be feeling the pain. Everyone that's got short in this move or after this move, they've been stopped out. Other people are now thinking this is a long trade. So there's a lot of emotions going on up here, and there's a lot of orders being executed here. This allows a big fund or institution to just load on a massive position, if they need to. A lot of these funds, etc., they're just handing over trades to their execution team. They're just saying, I need to get this position off for whatever reason. We need to change our book. Sometimes these funds are shifting their portfolios or shifting their exposures, and they've got a massive amount that they need to load off. So then it goes to the execution team, and the execution team, they've just been given a job for the day. So I need to sell this today. Your job is to get the best price. These areas are the areas where there's enough liquidity for them to be able to get a bold position on. If they just start selling here or here or here, the market is just going to absolutely collapse, and they're going to get like 1/10 of their position on. Then their boss is going to be going crazy at them. You've cost us this much money, you haven't done it right, you haven't executed the trade properly. So the execution, it requires the liquidity in order for that to happen. We need liquidity. The market always needs liquidity. So these are the areas where that kind of trading can happen, and where people are stopping out, people are getting it, institutions are loading off positions or loading on positions. These are the places that we, as retail traders or as professional self-employed traders or independent traders or independent fund managers, we can't compete with those guys. We haven't got the inside information. But what we can do is we can limit when we're trading, and we can get active in these areas of interest. We can try and avoid trying to predict what the market's doing all the time, and we can get active when the opportunity presents itself. When people are in pain or fear or anger or happy, we want to get in those active areas of the market. That's where we can add value. That's where we can take our small edge from the market and take our small piece. And we know there's a high probability that this mean reversion is going to happen. This reversal is going to happen. That's how we do it. Guys, the market ranges 70% of the time. 70%. Again, if you're trying to trade the trend here, the trend is up. You haven't had much luck really trying to buy for a continuation of this trend. Unless you're just scalping and just buying little bounces and levels, etc. But within the corrective strategy, if we zoomed in to any of these phases, guaranteed there's multiple corrective setups. One here, potentially one's in here, all these spikes. all these spikes that are happening, all this volatility, that's where corrective setups are happening. That's where these corrections are happening. That's where these mean reversions, these turnarounds, these short-term spikes back and forward, and that's where we want to get active. We want to take our little slice from the activity.